Okay, welcome to the webinar. Thanks for joining me tonight. I'm going to go over a few articles that I wrote for the Globe and Mail. My name's Anwar Husain. I'm a wealth advisor at Richardson Wealth in Toronto, Canada. And I'm also a university professor. I teach finance at University of Toronto at their business school. And I've also taught in the past at Queen's and McMaster. So here's a couple of things that wanted to go over from the articles that I'd written. So the first thing is a quote that I like. John Kenneth Galbraith, he's a Harvard professor who was also an advisor to John F. Kennedy. And he said the only function of an economic forecasting is to make astrology look respectable. So he's an economist and he's saying it. I guess he's at least acknowledging what everyone else sort of knows. When you're a scientist, you can predict the results of experiments, but when you're in social sciences like history, political science, and economics, it's very difficult to predict what's going to happen in your field. You can explain what happened in the past, but there's too many variables out there to allow you to effectively predict what's going to happen next. But it doesn't stop economists from trying, and they get it wrong a lot of the time. So let's talk about the topic today is what's an economic crash going to do to your portfolio? So here's three things you should ask. First of all, when will the next recession arrive? What will be the impact on your portfolio? And what will be the impact on your retirement plan? I'd argue that number three is really the most important and really the only important one. For the first two relate to number three, but they're usually top of mind for most people. Okay, so let's go over the first one. When will it happen? As Mr. Galbraith said, nobody knows. You can try to make an educated guess, but that's all it is. It's a guess. And the ability to predict in market time, it's almost impossible. And I'll go over a couple of different investment philosophies. One is you could be a value investor or a growth investor. Okay, a growth investor is somebody who's buying the next big growth company, Nike, Microsoft, and trying to get in early. A value investor is somebody who has assessed that a company is mispriced. It should be trading at a higher price. It's a large existing firm, and they buy it at a low price and they hold on to it. Both of those values and growth styles have done well in the long run, depending on managers. So you've had managers who've been successful as growth managers and as value managers. But there's never been a market timing manager that has consistently been successful. It's almost impossible. You hear some of the stories like The Big Short, where the guy called the crash right, and that's a high profile one. And if you can do it, that's great. They'll make a movie about you. But the same guy has had sketchy results subsequent to that because it's very difficult to continue to predict what's going to be happening when there's all that many variables. Now, even if you got it right and you felt really good that I got out, you would need to know when to get back in again and also when to get out again and again. And so it's a cycle that continues. And the reason that's important is because the market recovery after a crash, the bulk of it tends to happen in the first 6 months after it hits its bottom. Nobody knows where the bottom is when you're living through it. And usually what an investor will do is if they stayed out of it, they'll say, I'll wait till the market recovers. And they'll wait a year or two. And they've missed the majority of the market. So they would have been better off just staying in if they had a reasonable portfolio and then going down and coming back up. Predicting when the valley is while you're going through it, it's almost impossible. And that brings up the last option. Well, why wouldn't you just stay out of it? Why wouldn't you just buy GICs? Most advisors will say, well, if you buy a GIC, after tax, you're not even going to cover inflation. And it's not an effective way to retire. You'll have very little money as compared to if you invested it properly in the markets. That is true, but there are some cases where you probably should stay out. And that's if you just don't have the stomach to be in the market. If you've never invested in stocks in your life, retirement is not the time to start. Just because your friends are doing it or you've been advised to do it, your personal risk tolerance may not allow you. So that would be a difference. You just have to get comfortable with the fact that you're going to invest in GICs and you're going to have to live off of that return. Now, what's the impact of on your portfolio of a market crash? And it's going to depend how your portfolio is set up. If the first thing is industry concentration, if you have your portfolio spread amongst different industries, you're likely going to buffer it better, the impact of the crash. If it's all in one or two industries, then it just depends how those industries did. A good example is in Canada in the past, you used to hear the old adage that if you just buy the five big banks in Canada and hold them, then you'll beat the market in the long run over 10, 20 years. And that might be true, but the problem is when 2008 happened, if you just had the five big banks, your portfolio probably went down by 50% in 3 months. And every time you check the news, it was like Armageddon and it was going to continue. You didn't know when it was going to end. That's a tough thing to swallow. A 50% decline in less than a year. So now it did come back, but if somebody was more adequately diversified, it wouldn't have been that extreme. The second thing is, are you holding dividend paying stocks or are you holding growth stocks? So dividend paying stocks are what they sound like. Large companies, Microsoft, Walmart, they pay regular dividends because they're very cash flow positive. Growth stocks would be, technology companies, smaller, mid-sized companies. Dividend paying stocks will generally perform better in a recession. So if you have a lot of dividend paying stocks, you will not go down as much. You still will, but not as much as a growth portfolio. Ironically, you would expect that a growth portfolio outperforms the dividend portfolio in the long run. But a lot of studies have shown that it really doesn't. Dividend stocks, even though they may be more boring and mature, they tend to perform better in the long run as well as a group. Okay, so there is an argument to be made for that. The third point here could be a webinar on its own. What approach? How do you pick these stocks in your portfolio? Now, you should have at least 30. Each portfolio manager would have 30 plus stocks for each region. If Canadian equity would have 30, US 30, etc. You could get an exchange traded fund. You could use a manager like a mutual fund or a pension fund manager. Or you could do it yourself and create your own scenario. I'm going to argue against the do-it-yourself right now. I know people like doing it, but it's not a logical approach. First of all, it may be fun, but doesn't mean you're going to be effective at it. What you have to think about is the vast majority of managers, professional managers, do not beat the market after fees. So if that's the case, then what makes you think you can beat the market? And if you can consistently, there's a very lucrative career for you as a portfolio manager. You don't need to worry about your own portfolio. You make millions managing other people's. So if you take that off the table, then the question is, well, why would you use a manager if the vast majority don't make it? If you don't know how to pick the manager, then I would say an exchange traded fund would be the way to do it. But if you do have someone who can help you pick a manager, an advisor or some research that you've done on a long historical record, then a good manager should be able to buffer the return on the decline in a market crash. An advisor should be able to help you if they're good at it. If they're recommending their own firm's products, then clearly that's a red flag. But otherwise, if you got the right manager, you'd have a less decline. But if you don't know how to get the right manager, you don't have an advisor, you don't know what to do, then an exchange traded fund might not be a bad idea. The only catch, the pros and the cons are, the pros would be it'd be low fee, and you're fully diversified. And you don't have to worry about a manager change because it's really just a computer program that's picking the TSX 30 stocks. The negative is that when the market goes down, you'll go down by the full amount of the market. by definition. It is you're holding the market. And that's sort of the irony is when the market crashes, people will usually say, why were you paying fees to a manager to lose money? That's the time where a good manager would have lost much less than the market as a whole. When the market's doing well, like the last 3 years in Canada, you don't really, that's the best time to be an exchange traded fund because they're going to go straight up with the market. But when it crashes, you probably don't want to be in one unless you have no other choice. And what's the impact on your future? Now, it's going to depend if you're retired or saving for retirement. If you're younger and working towards retirement, then you're probably in pretty good shape. Emotionally, if you can get past the fact that the market is declining and you think of it that you are now buying at a lower price, then that's a good thing for your portfolio. You're making annual contributions to your retirement fund, your TFSAs, and the market's gone down, so you're buying it at a cheaper price. But if you are retired, you're doing the opposite. You're pulling money out to pay for your living needs. And you're pulling money out when the market's gone down. So if you don't have a buffer zone, then you're going to be pulling it out at a loss. And that's the second point. So you need enough of a buffer. A buffer would be bonds. And that would be something that would ride you through the storm. How much should you have in bonds? You hear general sayings like, take 100 minus your age, that's your equity component. I find those not very helpful because everyone is not a formula. That's a rough rule of thumb that may or may not apply to you. What you need actually is a minimum of 3 years of withdrawals in bonds if you're retired. 5 years would probably be better, but 3 is the minimum. And you get 3 as a number because that's around how long it takes for a very deep market crash to recover. In 2008, the Toronto Stock Exchange recovered about 3 years from valley back to peak again. So if you had bonds, and if you're taking, say, 50,000 a year out for your income, and you put at least 150,000 in bonds, you could sell your bonds without taking a loss for 3 years until the market recovered. And then you would reallocate at that point. The last point is the emotional impact, which I touched on. You obviously have to be able to handle that. If you just can't handle the market, you don't need to be in it. But if you can logic your way through it and say, well, I can ride this out, or I'm retiring and I just will be buying it at a lower price, then that's a good thing to do. Now, what will be the impact of a decline on your personal portfolio? Have a look at it and see how it stacks up. I've put two axes. Do you have growth or dividend paying stocks? And are they concentrated in a few stocks and industries, or do you have more than 30 stocks and in a variety of industries? So if you have a large number of stocks and they're dividend paying and you're in the bottom quadrant, then you're going to be pretty buffered for a recession. If it's the opposite, you have few stocks and you're in a higher growth type of industry, then you are going to be having a deeper decline. You probably had a really good 3 years as the market was going up, but it'll be a rough ride on the way down too. Hey, you just need to prepare for that. The other two quadrants, if you have a lot of stocks that are in growth, it depends which growth companies you have, or if you have very few dividend paying companies, also depends which ones you have. So those are question marks, but that gives you a ballpark assessment. Now, how to prepare? The first most important thing, you need to have a detailed set of projections that set up your personal retirement plan. Okay, so you need to, based on your goals, how many years is it before you're going to retire? Or if you're retired, how much are you spending? What are the things you like doing, traveling, etc.? And what's the investments that you have in place right now? Once you have that, your advisor should be able to set you up. If you don't have that, the rest of it is just sort of noise. But if you have that, then the next thing is maintain a sufficient barrier to help you ride through the storm, because it's going to come. And then when it goes, another one will come, and so on. So you just have to be able to deal with it. And then the last thing is you are likely going to help yourself if you have a dividend-based portfolio. okay, because they will buffer you a lot more during a difficult time, and they do perform well in the long run as well, as long as it's diversified. Whether you do exchange traded funds or portfolio managers, we can talk about that another time and future webinar, because as I said, that's a topic on its own. Okay, so I think I've tried to keep it to 15 minutes. So it's a live webinar, so I won't have Q&A available. But if you have questions, feel free to email me, anwar.husain@richardsonwealth.com, or you can phone me, 416-869-6963, or message me on LinkedIn. Also, I'm going to be replaying this, a taped version of this on my YouTube channel, Corporate Finance by Anwar, which was primarily for my university students, but I'll create a section for personal finance. And also, if you have suggestions for future webinars, I'm going to try to do one every 2 months. And we can, I'm open to ideas that people have. Okay, so thanks very much for tuning in. Hope you enjoyed it. And as I said, if you have questions, feel free to give me a call.